The broadcast is now starting. All attendees are in listen-only mode.
Thank you, Ivana, and good afternoon, everyone. I hope you're all doing well. My name is Muhammad Kaisi, as Evie mentioned, and I look forward for a very interesting webinar on a very important topic that is personally close to my heart, which is operational risk. If you have any questions throughout this program, please don't hesitate to write it in the chat box. I will be more than happy to address any of your questions by the end of the presentation if we have time. Just one moment. Okay. Just 1 second. I want to make sure you're seeing my presentation. Evie, can you guys see my presentation? Ivana?
Yes. Yes, we can see it, but just it's not in the presentation mode. So
okay.
Let's.
Just 1 second then.
Mohammed, can you hear me?
Yes, I can hear you. Can you see me?
We cannot see you, but we only see the presentation.
I don't know why. If you can just the video, it's showing on my end. And just 1 second. Can you see it now?
Okay, now we can see you.
Okay,
yes.
very good.
Yes.
So
can you test with the presentation if it's all okay?
Yes.
Move forward and backward.
Okay. So good afternoon again, everyone, and welcome back. So this very short webinar is going to be based on 3 sections that I want to talk about. First, I want to talk about some industry challenge facing the financial industry. We have many challenges, especially in a post-pandemic environment, that are impacting the financial service industry in many aspects. So we will discuss that, and we will use that as an entry point to see how operational risk will fit into this overall challenges that are facing many of the financial organizations in the region and globally. Second, I have selected a few operational risk topics that I believe are very essential for us to discuss, especially as it relates to really what is operational risk. I believe until today, operational risk is not understood as it should be, and at the same time that there is confusion as to the relationship between operational risk and other risks that exist in the organization. And therefore, I really need to make sure that we have a very good understanding of that. Ivana, am I being seen well?
Yes, all good.
All right, very well. And the third section that I would be talking about is the 3 lines of defense, or the 3 lines model, the updated model to the 3 lines of defense, and how that fits in the overall governance framework. So to start out with, what are key challenges facing the future of banking and the future of financial institutions? We are in an age of major disruption, especially in a post-pandemic environment. We are seeing the emergence of many financial technology organizations, or what is known as fintech, that are playing a complementary role to the traditional banking services, especially as it relates to retail banking. And we are seeing these organizations having the flexibility and the ability to provide more customized, easy services that is further aligned with customer expectations, especially as it relates to the millennial generation that is coming our way, that has a different customer trait to the traditional banking services that the traditional customers wanted. So we have fintechs coming our way. Many financial organizations, especially banks, need to assess and identify and understand to what extent is fintech really going to impact the way these banks are going to operate. It's going to impact many of the financial services that we provide. It's going to impact the financial service experience. It's going to impact many aspects, which is going to result in many new types of investments and technologies and products that banks need to create in order to be able to start competing in this arena. And as we will see later on, when we talk about operational risk, we can see that we have the risk of system failure, the risk of product failure, all comes under the category of of operational risk, especially as it relates also to the human capability or the training requirements of the people in the banking environment that will be able to create such products and implement them effectively and efficiently. So this is one thing coming our way. Second, we have central bank digital currencies. CBDCs are on the rise. Many central banks around the world are now currently testing the concept of CBDCs and to what extent is it a viable option. Now, once CBDCs are created, this is going to also cause a bit of a disruption to the retail banking industry, especially. It will allow many individuals to open accounts directly with the central banks, and this will also significantly impact the user experience and the customer experience when it relates to CBDCs. We have cryptocurrencies. We all know what they are. They are also altering the name of the game, especially when it comes to payments. We have many consumer behavioral changes to take into consideration. We are going from a generation of savers to a generation of consumers. And this is also going to change the banking model or the banking transaction in that regard. The new generation of consumers is much different from that was 20, 30, 40 years ago. And this will directly impact the financing model. It will impact the types of products we need to create in the banking system. And of course, we have the biggest challenges of all, neobanks, digital banks, newly created organizations who do not have to deal with legacy costs. They don't have to deal with the bureaucracy that we suffer from in our existing traditional based banking system. And I believe this could be the biggest challenge of all, really. I recall in my earlier days during my master's program, one of the first books they told us to read was a book called Who Said Elephants Can't Dance for the CEO of IBM. And in that book, he talks about his story of taking IBM from a very traditional bureaucratic state to a state where it can be able to compete with the new changes of that time, especially as it relates to internet and technology and all of the different elements in that regard. So digital banks, I believe, are going to be a major competitor to our commercial banks as we know it. Currently, traditional banks suffer from many inconsistencies in their processes and many inefficiencies. We have bureaucracy in taking decisions. We have the amount of time it takes to issue new products, the ability to respond to the market swiftly. And with digital banks and fintechs on the rise, who don't have these high overhead costs, don't have all of these very lengthy decision-making processes, traditional banks, they need to change the name of the game. Now, how does that relate to operational risk? You can respond in two ways. You can either respond in a way where you are swift, efficient, and effective, taking into consideration the losses that you may incur on the way as you implement these changes, and these are operational risks, or you do it in a very haphazard way in which you will end up suffering major losses. So these are the reason why we are trying to relate the topic of operational risk and at the same time as it relates to the topic of the challenges facing the banking sector. And this is why I'm going to quickly go through key operational risk topics in this webinar, just to make sure we really understand how we will align that further with the challenges facing the financial industry. So the new banking model definitely will, we need to take into consideration the key changes to adapt we will go under major transformations. These transformations will increase already existing operational risks. And this is why we need to consider what kind of risks we are going to face in the future. According to the on-risk report that was issued by the IIA last year, they've highlighted around 11 key risks to take into consideration. And later on, we are going to learn that operational risk really exists everywhere. It exists in every process. Every risk has a corresponding operational risk. And I will explain that in around 10 minutes, how the fact that every risk has a corresponding operational risks makes our responsibility towards operational risks much, much bigger. So we have 11 key risks to take into consideration in 21 and beyond. Of course, cybersecurity risks. This is critical, especially in a post-pandemic environment where we are all going into this new era of technology. How does that relate to operational risk? Well, any breakdown, any possible breakdown in any systems or controls that we implement to mitigate cybersecurity risks, at the end of the day, is an operational risk. Therefore, when we think of cybersecurity risks and the controls that we introduce to address cybersecurity risks, we also need to think about the possibility of failure in these controls, leading to the materialization of cybersecurity risks. Third-party risks. Third-party risks, we cannot talk enough about third-party risk management, especially that many organizations are now focusing on outsourcing. This increases heavily the responsibility on the shoulders of those in decision-making positions, as it relates to making sure they have enough controls set up to manage third-party risks. Well, again, any failure in any of the controls that we put on supplier due diligence, supplier selection, on the way we assess and measure supplier services and quality and so on, relate to operations. Board information. I really believe board information is not number 3. It's even more than number 1. My personal and professional opinion. Why? Because I have seen so many board of directors take the wrong decisions, and God forbid, sometimes they actually allow fraudulent activity to take place. They actually legalize it, not knowingly, through decisions they make because of the wrong information they receive or the misleading information that they get. And again, how does this correspond to operational risk? Well, the failure in data governance, the failure in all the different types of management information systems that we designed and implement to make sure that we are adequately getting the right information at the board desk also play a major role. Sustainability, again, talking about the long run. The pandemic has taught us very painful lessons. The 2008-2009 crisis taught us a very painful lesson as well. And the problem is we don't learn from our mistakes. We don't learn why we are not prepared. This is why sustainability is very important. We really need to make sure that we are setting up the right systems, the right long-term planning, the right strategic vision to be able to address sustainability challenges. And the failure to do so is operational risk in itself. How about disruptive innovations? I just talked about fintech. I just talked about so many other emerging challenges facing the financial service industry. And if the financial service industry, 1, acknowledges these challenges, 2, responds to them effectively, 3, sets the right systems and controls to respond to them, and 4, makes sure that these controls are working effectively, because if they don't, this increases the level of operational risk. We will not achieve our objectives and the objectives of our stakeholders as well. How about economic and political volatility? That is a very major challenge that we are up for. We are now seeing in the post-pandemic environment, we are seeing economies responding in ways that we might not have foreseen. And therefore, we need to adapt our internal systems and financial planning processes accordingly. If we do not, if whatever measures we put don't work, this increases the level of operational risk. Organizational governance. I will talk quickly about the 3 lines model towards the end of this webinar. If we really don't get a very sound understanding of what this model is trying to tell us, especially as it relates to risk ownership, as it relates to control ownership, then we are in big trouble, because again, governance is at the heart of our ability to achieve our objectives. And if we design the right governance systems, and if we design the right governance frameworks, we will be able to better achieve our objectives. However, if we don't set the right governance procedures, if we do not set the right governance systems, that increases operational risks, because the failure of governance is an operational risk on its own. Data governance, again, we talked about that. That's a major risk, not having our ability to organize our data in the right way, especially that we are heading into a world of fully automated processes, capturing data from all over the spectrum. If we do not have these proper systems to gather this data in the right way, this is also impacting our ability to find the right data that enables us to take the right decisions. This is why data is important for decision making. And there are two elements that we need to take into consideration. We need the right data, and we need it at the right time. And therefore, we need to have the right systems that enables us to get the right data at the right time. The failure in these systems, the possibility of failure in these systems, which is an operational risk, will result in data either not received completely or not at the right time, resulting in improper decision making, losses, and not achieving effectively our objectives. Talent management, this is a critical thing. One of the main categories of operational risk relates to people or mistakes done by people. Right. Now we have a new generation that is completely has different aspirations, especially in the workforce. And we need to make sure that our organizations have the flexibility to adapt to the changing nature of the workforce. And if we do not have that ability, and again, we don't develop the systems around our HR capabilities, our talent management capabilities to address this change in employee culture, employee aspirations, in employee objectives, we will not be able to get the right people at the right place to take the right decisions to achieve our objectives. Again, that is a major operational risk when I'm not able to capture the talent, I am not able to train the talent, and I'm not able to keep the talent. If these three systems are not in place, or if they are, and there's a possibility of them failing, that is an operational risk on its own. Culture. I cannot talk enough about culture. Okay. Last week we had World Mental Health Week. Till when are we gonna not talk about the toxicity in the working environment? Till when are we going to address culture as just a cosmetic topic on the agenda of the audit committee or the board of directors? Till when? Toxicity in the workplace is having a significant impact on employee mental health, and many people leave organizations because of toxic working cultures. And therefore, if we don't have the proper setup, we don't have the proper systems to identify toxicity in the workplace, how to deal with toxicity in the workplace, ladies and gentlemen, we are also going to be facing major challenges in retaining the right people or even training them. And I believe culture also is a topic that is not provided with enough attention at the board table. We need to get that in place. Of course, BCM, business continuity management, and crisis management are also critical topics, especially for operational risks. If my BCM doesn't work, I lose. Simple. So now you are being able to try and correlate a little bit how I'm trying to integrate the changes in today's working environment, leading to changes in procedures and processes, leading to the emergence of many risks, requiring us to build many new systems where the possibility of losses as a result of breakdown in these systems is the operational risk we are trying to identify and make sure is working properly. And ladies and gentlemen, look, every time I really try to get this straightened out in many people's minds regarding the fact that, okay, we talk about credit risk alone, and then we talk about market risk, we talk about concentration risk, we talk about interest rate risk, and then we talk about operational risk. as if operational risk is a separate category independent from these other risks. This is not the case. Operational risk exists in every single process in the organization. All risks have controls that are designed to handle them, manage them, mitigate them. The possibility of failure in these controls is the operational risk we want to focus on. And this is, if there's a message out of this, training or this webinar, I want to try to relay to you is this understanding. We need to stop treating operational risk as if it's just a measure we need to calculate. Definitely, in my own humble professional opinion, I don't believe enough capital is being set aside against operational risk, to be honest. Even those that are measuring it on the standardized approach for sure, or sorry, the basic indicator approach, or even a little bit of other operational risks under pillar 2, operational risk remains very high because it exists everywhere and could be the nature of measurement is not aligned with the severity of this risk. Could be something that we need to discuss. So what really is the definition of operational risk, which is the risk of loss resulting from inadequate or failed internal processes, people and systems, or from external events altogether. So this is why we always need to think of where will procedures fail, and procedures exist everywhere, hence operational risk exists everywhere, in addition to the possibility of external events. So what does that mean? What is operational risk failure? It arises from the potential for failure in the course of operating the business, any type of failure. The banks use people, processes, technology to achieve their business plans. Any one of these factors may experience a failure of some kind. Accordingly, operational risk can be defined as the risk that there will be a failure in people, processes, or technology in any given business unit, which again increases the importance by showing us how operational risk exists everywhere and the need for us to really understand whether first we have designed the appropriate systems and to what extent is the failure of these systems impacting our objectives. Therefore, we need to agree something, me and you. Okay, I want to make this like very simple for now. Maybe in later courses, once we drill down into the details, it gets a bit more complex. But let's keep it very simple, ladies and gentlemen. In your organization, we develop a strategy. Basically, this strategy will highlight the steps that this organization needs to take to achieve its objectives, okay? And based on the development of this strategy, we need to translate that strategy into individual objectives that would be designed and defined at the departmental and procedural level for every department. So every department in your organization needs to have documented objectives. And as a risk management professional, every time I see risk registers without objectives, I tell them this is not risk management. You cannot identify risks without knowing your objectives. Second, we need to differentiate issues from risks. So risks are not gaps in the system. Gaps are gaps. Risks are the possibility of future incidences, future failures of any kind impacting business objectives. So basically, the existing gaps you identify will be an input into your ability to identify risks, but they are not risks on their own. So if currently you don't have a procedure, you don't have a policy, you're lacking a system, that doesn't mean you have that is a risk. That's a gap. It's materialized, it's there. Now, what could go wrong as a result of the gap is the risk. So we need to understand every department needs to document and detail its objectives. And at the same time, every department needs to identify the risks, which are the potential future events that may impede the achievement of these objectives. Once these risks have been identified, or these, i.e., future events, we need to agree, okay, what type of control do I need to design to mitigate the impact of these risks? Okay? Do I need to design a system? Do I need to design an automated control? Do I need to design a manual control, a preventive control, a detective control? What kind of control do I need to design? Once I have established the nature of this control that I need to design to mitigate this risk to achieve my objective, is where I can start thinking of operational risks. So operational risk is the possibility of this specific control failing. And therefore, since every department in the organization has an objective and every department in the organization has a control, has a risk, and has designed a control, then operational risks, you can say, are the possibility of these controls failing in all of these different departments in the organization. This is why I personally refer to operational risk as the mother of all risks, because at the end of the day, it exists everywhere in the organization. Now, so as you can see in front of you, every type of risk that may impact our ability to achieve our objective at the end of the day will have a related operational risk. So for example, I have the objective of making sure my non-performing loans ratio does not exceed 3%. The risk is the possibility of it exceeding 3% through defaults. The control I have in place is the credit policy. Well, the possibility of this credit policy not being effectively implemented is the operational risk on its own. So now me and you can start seeing how we can relate to operational risk and all other risks. And as you can see, since this is the universe of possible risks that you may be exposed to, we need to take into consideration that operational risks exist in every step of the way. Now, so if you are a bank and you want to be resilient and deal with the future challenges coming your way, especially in today's environment, means you will need to hire new people. It means that you will need to implement new systems. It means you will need to create and market new products, and you will need to completely define a new user experience. Right. All of these elements that I have talked about, they will result in the emergence of new systems, new policies, new procedures. Therefore, when we talk about operational risk and resiliency, we need to make sure that we have a methodological approach that these systems are well designed and working effectively. And going back to our friend, the CEO of IBM, he created a book where he said, elephants can't dance. Who said elephants can't dance? He was talking about IBM at the time. Today, in today's financial environment, traditional based banks are the elephants of yesterday. And if we do not find a way to make these elephants dance, many banks, many financial institutions will not survive the coming 5 years. Honestly, there are too much disruption happening at the same time. And the elephants of the financial industry are very big, very bureaucratic. We need to change, and we need to use operational risk as a way to ensure that that change happens in the right way, in the effective way, in the efficient way, in the smooth way. Therefore, ultimately, operational risk is about the failure of controls or lack of controls. So that operational risk management is about establishing and maintaining an effective and cost-effective control environment across all risks. Therefore, we really need to make sure that all risks are adequately catered for through internal controls, whereby I have taken into consideration the possibility of failure in these internal controls as part of my operational risk management framework. Now, the key difference between operational risk and other risks and other risks are that every single person in the firm is responsible for some aspect of that, and operational risk is involved in every single activity in the firm. This is what you need to keep in mind. Every time you see a procedure, every time you see a system, every time you see a control, you need to tell yourself that the possibility of failure of this specific system or procedure is the operational risk. And this is why I want to talk a little bit about a root cause analysis and cause event and effect analysis. Why? Because as part of operational risk, we need to make sure that once we've identified a possible event or an existing event, by which we really need to go down into the very deep details of finding out why it happened, so we can remediate these procedures, we can fix these systems for them to work appropriately in the future. And this is something about operational risk that many professionals still are challenged to understand till today, why we really need to do root cause analysis, because this is the only way that we can fortify our systems in order to making sure that even the smallest of events don't translate into very big events in the future. And this is why root cause analysis goes into the heart of operational risk management. Now, all of you may have seen this operational risk management framework model. What we need to take into consideration, I'm going to quickly go through some aspects of this framework. So when we talk about corporate governance, what do we mean? We mean how our organizations are directed and controlled. Specifically, if I want to relate this to our discussion now, when I talk about governance, I want to ask, what is the strategy? What are the systems that are being designed by the management, by the board, at the governance level to enable and ensure that my individual departments throughout the organization are effectively identifying their objectives in alignment with organizational strategy, making sure that they have the ability to identify the possible events that might not allow them to achieve these objectives, also making sure that they are being able to design the controls to manage these risks, taking into consideration the possibility of failure of these controls, which is operational risk. So this is a huge thing. When we talk about governance as it relates to operational risk, we are really playing a big game here. Governance is not only about your board meeting 4 times a year and your committees meeting 4 times a year and all of them signing the necessary documentation in accordance with regulatory requirements. This is not governance. This is compliance. True governance is making sure that in the DNA of my organization, my individual departments, processes, units, and entities have this inherent ability to identify their objectives and risks and controls and understanding what it means as it relates to the possibility of these controls actually failing. Now, take it down a level. We were just talking about how banks in the future now are going to be facing major challenges as it relates to effectively designing new activities, processes, products, and systems to deal with today's challenges, to become more resilient. And this is where operational risk helps us in making sure that they are effectively designed in the appropriate manner. Now, let's talk about 3 other key components or pillars of operational risk management. Indicators. Okay, when we talk about indicators, we are talking about key risk indicators and key control indicators. What does that mean? What it means is that assuming, and this is where many organizations get it wrong, and that's why I always recommend that before we venture into identifying indicators, let's make sure we've identified the right risks. Or you know what? Let's get our objectives right first. I want to go right from the start. Okay? So many of us in the last 10, 15 years have been identifying risks without knowing what our objectives were. To be very honest, let's be honest with each other. That's at least my opinion. So let's get the objectives straight. If we do get the risks and controls right, well, me and you, we need to start thinking, okay, now that I've identified the right risks and controls, and I said that the failure in these controls is an operational risk on its own, I need to design indicators or types of measurements that will give me warning signs that this risk is about to materialize or this control is about to fail. And this indicator is very essential for us to make sure that we are resilient. When we are talking about resiliency in this webinar, what does resiliency mean? I need to have the ability, the agility to react very quickly and swiftly. This just doesn't happen by wishful thinking, ladies and gentlemen. Okay? It doesn't mean if today I'm in a good mood, I'm resilient. No, I need to have a system behind this. Okay? This system behind it is having the ability to identify the objectives, risks, and controls. Adding to that, the ability to design the appropriate indicators that tell me, wake up, something wrong is about to happen. Okay? And then I respond quickly before that event actually materializes or that control actually failing, leading to that event increasing in possibility. This is why indicators as part of the operational risk management framework is so essential. But again, there's a prerequisite to that. I cannot design indicators if I have not identified the right risks to begin with. Now, the second part, or basically it's the first part actually, which is the RCSA or the risk and control self-assessment. When we talk about risk and control self-assessment, what does that mean? It means exactly what I have been talking about for the last half an hour. Having these departments being able to really identify their own objectives, risks, and control. In the next part of this session, or in the last one, we are going to talk about the 3 lines model. What is the key message from the 3 lines model? Let's get past all the formalities. The key message behind the 3 lines model, in my opinion, of course, is explaining to management in a very, very, very professional sense that you are the owners of the risks. You are the owners of the control. It means that every single department is responsible to identify its own risks and controls. And no, definitely, the risk management function is not responsible to tell you where your risks are. They are responsible to help you identify these risks in a methodological manner. And this is also something that we need to agree on, that many still do not appropriately try to implement. We are facing, one of the main challenges we are facing today is that many of our governance systems are being built upon norms, traditions, customs, and people using their own understanding of how things should be. Okay, and in the 3 lines model, I will get into more details about that. But I just want to say regarding the CRSA or the RCSA, we need to make sure that the individual departments in the organization are equipped and enabled to be able to identify their risks and their controls in the most appropriate manner. Now, the third pillar of the ORM framework, events. What does that mean? It means, ladies and gentlemen, I need to have the ability to identify internal and external events. Why? Again, me and you agreed. Operational risk is the possibility of any control in the organization failing anywhere. Therefore, my ability to identify internal and external events quickly, analyzing them, and adapting and preparing the organization to deal with them after analyzing their causes is one of the key elements that allows me to be resilient. Many times we get very small events, we ignore. They end up being a sign that something very, very, very dangerous is about to happen. And sometimes it does happen. And unfortunately, if we are not prepared for it, we fail. And this is a very important area that all of us need to take very, very, very seriously. This is why when we ask departments throughout the organization to send us any type of possible events or small events that happen, the reason is we really want to get a better understanding if there are structural deficiencies in our existing procedures and systems that might result in a much bigger catastrophe. And of course, as part of the ORM, we need to think about scenarios, we need to think about modeling, about what could go wrong, and design the appropriate reporting mechanisms that enables us to effectively foresee the future and getting prepared for it. So let's move on to the 3 lines model, which I want to conclude the last 15 minutes of this webinar. So what's the 3 lines model and how does that relate to operational risk? As you all remember, the 3 lines of defense, one of the key challenges that existed in the 3 lines of defense, mainly I would put them into 2 categories. First, the roles. Second, the mode of communication. So as you can see in the 3 lines model defense, we had one-way communication, we had individual silos, we had departments not talking to each other. So at that point in time, when we had this model, we used to say, okay, the first line of defense. Who are the first line of defense? The first line of defense are those departments that are doing transactions with the outside world. So basically, they are the first departments that may be exposed to any type of events that may hamper our ability to achieve our objectives. Therefore, we need to make sure these departments in the first line are adequately fit with the appropriate control. And we said this first line reports to management. Then the second line, we said also the second line reports to management, and it includes risk management, compliance, control, security, and so on. But look, they don't talk to anyone. They just talk to the management. Internal audit talks to the management and the board. But at the same time, we didn't understand what is the role of management. We didn't understand this type of communication that is one way, how it's happening. There's no integration of communication into the flow of the organization. And therefore came the new model that said first, okay, the first thing I want to do is I want to remove the word defense because we are not under attack. As an organization, we are not always under attack. We need to achieve objectives. And then we had a very interesting understanding here that we need to take into consideration. Here, and especially in this area here, it became very clear now, management is responsible to achieve its objectives through the management of risk and making sure the first line roles have the appropriate ability to achieve their objectives through the management of these risks. However, we understand that this management is not a risk management professional, does not understand risks the way we do, and therefore we made sure that we have a second line role, a risk management function that can help the management and enable the management to identify its risks to achieve its objectives with the first line. Now, many people will directly come now and tell me, but Muhammad, wait a second. Risk management is an independent function of the board. You are now telling us that risk management is part of management. Well, of course it is. Of course, risk management is part of management. It doesn't mean if they are part of management, they cannot report to the board, not at all. But their role is an enabler of risk. Okay? Risk management functions are not designed to identify your risks for you. No. Process owners are the risk owners. Board is the ultimate owner of the risk. Management has risk ownership. Okay? This risk management function is there to provide you the expertise and support to help you and enable you in identifying and managing these risks to the proper design of internal controls. So if I had an operational risk function in the second line, this operational risk role is there to make sure that I am adequately analyzing all the events, I am adequately executing RCSA programs, I am adequately developing risk indicators, so management has the ability to be resilient and respond in a more capable manner. Now, they are part of management, yes. They have a reporting line to the board, yes. Just like the CEO has a reporting line to the board. The CEO has a reporting line to the board, right? He's management. The risk also has a reporting line to the board according to the freelance model. And yes, the board gave them with a lot of additional authorities. That's fine. They have that, but they are part of management. We always need to understand that. We cannot handle 3 internal audit functions in the organization. 1 risk, 1 compliance, and 1 internal audit. And the 3 lines model is really helping us understand the true role of risk management through the reporting line to the board. So the 3 lines model made this very clear. It made very clear that I have a 2-way reporting line between management and the board, where the board now is clear has a responsibility to delegate, direct, and invest with the management to enable them to respond to these risks in a very appropriate manner. Now, When it comes to internal audit also, the model has become very clear. The internal audit function doesn't look up. They need to look left and right. They need to align their work with the management. They need to coordinate. They need to make sure that controls are effective. They need to provide assurance as to the effectiveness of the controls, minding you that the possibility of failure in these controls is an operational risk. And when internal audit helps us through providing assurance on the effectiveness of these internal controls, the internal audit function is playing a critical role in fortifying our operational risk management framework in that regard. And I would like to always remind everyone, in the definition of internal audit, ladies and gentlemen, there's a statement that says also part of our role is to help the institution achieve its objectives, right? And objectives relates to risks, and risks relate to controls, and the possibility of these controls failing relates to operational risk. Now, as it comes to the two-way reporting line with the board, it's very clear now the role of internal audit, where they need to report to the board as it relates to the effectiveness of these internal controls and the impact that could have on operational risk. So, ladies and gentlemen, as you can see, the three lines model now is a loop that feeds into itself, whereby we have a clear path now of making sure information is reintegrating into the organization, helping the organization takes its decision in a much more appropriate manner. And it's this really true understanding of the three lines that will help us really get a good understanding of our organization. So in summary, okay, this is a very quick webinar. I try to put many topics in there together. But in summary, what does it take for us to become a more resilient organization, especially introducing operational risk into that element? We need to make sure, as part of our governance and risk management, that we are building the right strategy. We are building the right strategy using the right information. We are integrating risk into strategy development, an element that is not taken into consideration all the time. We are trying to foresee, based on the external and internal challenges that we face as an organization, what could go wrong. In external challenges, we are taking into consideration economic, monetary, technology, consumer behavior, political elements, legal elements that could impact this organization's ability to really achieve its objectives. Internally, we are looking into technology, people, processes, policies, procedures, and so on. All of these external and internal elements together, integrating them into our strategy, having this strategy integrate risk into it, and translating it into individual departmental objectives, leading into inherent risks that will impede our ability to achieve our objectives. Based on that, designing these appropriate controls. Policies, procedures are what? Policies are procedures are an outcome of this exercise. They are reflecting the internal controls that we design. And therefore, the possibility of failing these systems and procedures is an operational risk. If it is high, we will not be resilient enough to deal with the existing challenges. Now, how do we do that in a methodological way? We need to make sure that every department is conducting its own RCSA exercises to identify objectives, risks, and controls. We are effectively identifying the risk and control indicators that will tell us when a risk may materialize or when a control could possibly fail, and then being our ability to diagnose the smallest of events in order to make sure that we have identified these weaknesses in our procedures, to strengthen them, to make our organization be able to fight today's challenges in the most appropriate way, acknowledging at the end of the day that risk ownership lies within management, within the individual processes and procedures. So I want to leave now the room for some questions, because I think I have been talking for too long. So if you have any questions, if you can please put them in the chat box, if I am seeing it correctly. Ivana, will the questions appear in the chat box, or will you be telling them to me?
Yes, I do see a lot of questions, and just to clarify to most of the people who ask about the presentation, so we do not share the slides. However, we will convert the link online and we will provide you the link of the session as it has been recorded. I do have some questions, so I'll give you time to think of your questions.
I cannot see the questions myself. I don't know why.
Maybe you can export the view of the questions in order to see them better.
Ivana, I cannot see the questions. Can you tell them to me, please?
Okay, let me read a question that I received over email. So, what should be the relationship between operational risk management and fintech development, artificial intelligence, machine learning, no-code programming? That's the first question.
So definitely when we're talking about fintech, we are talking about the creating of new products that require new systems. The failure in these systems are operational risk. So we need to make sure we have a strong framework that enables us to test these systems very well before introducing them into the market. Now, with fintechs, one of the major challenges we face on a governance level as well relates to the entrepreneurial cultural mentality that exists currently in fintechs. And this entrepreneurial activity wants to issue products very, very quickly. And if we don't have the ability to make sure we are getting the right people, the right systems, the right procedures to test these systems, many fintechs will fail. And that's why they are failing. So we need to make sure we create a framework that enables us to really design and test these products before they are introduced into the market. So that is really the relationship between operational risk and fintech.
Second question from the same person, which is greeting us from Bucharest, Romania. So what should be the immediate strategic priorities the banks should take to maintain their operational performance, protecting their sustainability, profits, and their customer interests, including the micro SME, and to contribute also to the eradication of poverty worldwide, taking into consideration the current context of the COVID pandemic wave and the dramatic increase of gas, electricity, energy, and oil prices, and the need to combat the pollution and climate change?
It's too long. I got lost in the middle. Can you just copy paste it in the chat box?
Yes.
I don't know why I'm not seeing anything in the chat box. That's why.
So if you cannot access the question box, maybe I can send it to your WhatsApp?
Yeah, send it on my WhatsApp. So what should be the immediate strategic priorities that banks should take to protect their operational performance, protecting their sustainability, profit, and customers? Okay, so basically our question here is what banks, and currently how banks will need to respond. Well, okay, I don't know the name of the person who answered this question. And this is my own personal opinion, ladies and gentlemen. I believe banks first need to recognize that the way they were doing business is over. Okay, the faster we recognize this, the better. Now, second, they need to ask themselves which part of our business is the most impacted and which is not. So we have retail banking, we have corporate banking, we have treasury operations. Therefore, I would assume maybe the retail banking is the most area that is going to be impacted by the recent changes in the industry. And they need to ask themselves, okay, how will we change? A world without branches, a world without physical branches, a world with consumers who don't like to come to your office, a world with consumers who want everything done with the step of a button. If banks do not respond to this very quickly, ensuring that operational risks that we explained are well maintained, then we definitely have a problem. They need to recognize the severity of the challenges coming their way. Some are, some unfortunately are not. Now, when it comes to corporate banking and SMEs, maybe SMEs could also be impacted because the number of SMEs are increasing. And if they want to use the same credit strategy to SMEs they were doing prior to the crisis, I believe they will not be able to compete. So if they've already lost the retail banking, most of it, they can still capture the SME, but they need to be to rush because the SMEs could be captured before they know it. So and they need to do that. Now, as it relates to the increasing in gas and electric energy and oil prices, this is the normal economic changes globally. We need to see how that will change our interest rate strategy, our lending strategies, our corporate lending strategies, our trade financing strategies, and so on. So what are other questions, Ivana?
Okay, next question from the same person from Romania, George Staitu. What will happen with the jobs of the IT staff currently working in the software application development once the digitalization will be 100% implemented? Will it trigger an operational risk within the HR area?
So look, we are in a continuous process of development and change. This is too far ahead in time for us to think about it. I think that we are still at the beginning of our digital revolution, especially in a post-pandemic environment, which expedited things very quickly. Now, again, George, from an operational risk perspective, we just need to make sure that we have the proper systems in place to test these products before they go into market. We have to take a step back and just make sure that we are getting the right stuff in the market.
Hamad Al-Hamad is thanking you for the time and effort. Ali Al-Mansouri, quick question if possible, but we didn't get your question. So maybe Ali, you can use the chance to add your question. Yusuf, would the presentation of the document will be available? Okay, many questions are the same as this. The presentation will not be shared. However, you will all get the link of the recording of the webinar. Next question. Do you think, Hari Sholburi, do you think that compliance should review automation tools prepared for the business unit?
Sorry, can you say that again?
I think compliance should review automation tools prepared for the business unit.
Should compliance review information for the business unit? Is that
automation? Yes, I think there is some mistake. It should be automation tools.
Okay, so should compliance review the automation? If you can send it to me on my WhatsApp, Ivana. Yeah, Ivan, okay. Do you think compliance should review automation tools prepared for the business unit? Well, look, what's the name of the person who asked this question, Ivana?
Person is named Hari Chaudhuri.
Okay, so look, we have an ORA process, which is called the operational risk assessment process. Every time you want to introduce a new system, you want to introduce a new procedure, you want to introduce a new product, this needs to undergo a specific process of review. And this specific process of review needs to happen in the quickest way possible. Now, compliance has a role to play. This role that they will play in that approval is to ensure that any regulations pertaining to this system or approval are adequately implemented. Okay, that is the role of compliance. Now, there will be a role for operational risk, and there could be a role for legal, and there could be a role for other risk management functions. However, the role of compliance is limited to ensuring the central bank regulations or any regulatory authority pertaining to the specific nature of these products is aligned with what is expected from them from a regulatory standpoint.
Should I go with next question? Pahim Sonda is saying, while developing a risk-based internal audit plan, the internal auditor conducts an internal audit risk assessment and develops a risk register with inputs, walkthroughs done with each auditable division. Can the risk management division use the above risk register developed by the internal auditor to build a risk register for the risk control and self-assessment? Again, a longer question, so let me send it to your WhatsApp.
Yes, send it, please. So while developing risk-based audit, conducts internal risk assessment and develops it. So while developing a risk-based internal audit plan, the internal auditor conducts an internal audit risk assessment and develops a risk register and walkthroughs with each auditable division. Can the risk management division use the above risk register developed by the internal auditor for the RCSA? Excellent, excellent question. Excellent question. The first thing we need to take into consideration is, let's ask the question in another way. So in an ideal scenario, the RCSA is complete and the auditor will rely on the RCSA for the risk-based audit plan. But taking into consideration that internal audit functions in most organizations were established first, and again, they are doing the risk-based audit planning for their own internal purposes. Let us make it very clear. Internal audit, risk-based audit plan should not, and I will underline, should not be used as a risk management tool. However, it definitely can be used as, or at least the underlying elements that defined this risk-based audit plan can be used as an input to the RCSA exercise for familiarization. However, it should not be used as a final product for the RCSA. It should not be used as a risk register for that specific process department. Why? Because internal auditors, when they do the risk-based audit plan, they are doing it very strategically. They are doing it at a very high level. They are not necessarily doing it for risk management purposes. However, they are only doing it to prioritize their own internal audit work. Therefore, it might not necessarily have taken into consideration all the different types of plans that are applicable, or the different types of risks that are applicable to that entity or organization. They might have just had just enough what they wanted in order to implement them. So we need to take that into consideration. So my answer to you, yes, it can be used, however, only for familiarization, not to be as a final tool or a final program or a final tool for them.
Next question. Can you elaborate the main difference between the old and the new 3 lines of defense?
Yes, the main difference between them, first, the word defense is no longer there. In the old model, no one talked to each other. There were silos. The first, second, and third line had no communication with each other. The third element to take into consideration, the third factor to take into consideration is the flow of communication between all the different functions in the and elements in the organization, and moreover, we need to make sure that a key element is that the role of management as a risk owner of risks and internal controls. These are the key differences. Management is clearly the owner of risk and is the owner of the controls. It's clarified, and the role of the second line is to help this management in identifying and managing these risks.
Next question. What if the business didn't show the risk they have in the RCSA?
Can you repeat that, Ivana?
Yes. What if the business didn't show the risk they have in the RCSA?
Okay, very excellent question. Who asked this question?
This is Ali Al-Mansouri.
Okay, Ali, this is a good question. Let me tell you something. For sure, I can assure you from now, there will be risks that they don't identify. Why? First, let's start out with that there are some objectives that they don't identify. That's one. Two, their lack of understanding of what risk is. Many organizations still look negatively towards risk. They feel risk is something bad. They don't think it's something good that we need to really embrace and look forward upon. Three, when we talk about risk, Ali, we are talking about uncertainty. Risk is talking about the future. Risk is about trying to foresee events that may or may not happen. And this level of uncertainty would result in risks not being identified. Now, what's our job? Our job is to ensure that with time, we are capable of enabling our risk management capabilities to identify the right risks at the right time. So it's a process. Risk management is not something that you will do at a certain point in time. It's something that it's a learning process that will only get better with time. So this is why definitely there will be risks not identified.
Next question, how does operational risk management apply to Forex, foreign exchange?
Okay, so to Forex exchange, basically, when we are dealing with FX risk is the possibility of losses that we may incur to the changes in the market, in the FX prices, very simply. And this is why we set many controls regarding limits, regarding approvals, regarding procedures from the middle office, usually, or the risk management, in order to make sure that this risk is not elevated. Any failure in these limits being applied, in these approvals taken appropriately, is an operational risk. And if they do fail, then the risk of losses due to the changes in market prices will actually materialize much more quicker and at a much higher rate. So this is the relationship between operational risk and FX risk.
Next question from Arza Berisha. How are we able to implement the new 3 lines model in our organization if we have the group mother organization above before they implement it?
If we have a what? Sorry?
Group. If they're a subsidiary, if they have a mother company above them. Okay. How are they going to implement the 3 lines?
Okay, I think I'm beginning to see them now in the chat box. Just 1 second. So, okay. So can you say that again, please, Ivana? I lost you there.
Yeah. So how are we able to implement the new 3 lines model in organization if we have the group mother organization above before they implement it?
Okay. So basically, you are a company owned by another company, and they didn't apply the 3 lines model yet, and how can you guys implement that on the ground? So look, again, the 3 lines model is a governance model, really. It is about the role of the board of directors in being able to swiftly implement. I have seen it happen. So at many times you have a mother company or holding company owning many subsidiaries. You will find the subsidiaries are more advanced in governance than the holding company itself. That happens. At the end of the day, it's about the board of directors of that entity and the audit committee specifically taking that proactive forward-leading role and pushing that company to design that model and implement it appropriately.
Okay, next question. Great webinar, Mr. Mohammed. This is from Ahmad Al-Naim. My question will be how to automate the whole process.
Which process?
There is no clarification. So if Ahmad Al-Naim is still with us, please write down the elaboration of the question.
Tell him we will talk about it, no problem.
Okay, great. Next question from Ahmad Al-Nizif. Is it necessary to have an indicator for control, even if the key risk has the indicator and the key control testing is enough?
Look, I'm not gonna give you the theory. I don't like theory. I don't think, to be honest, we are at a point in time now where we need to identify control indicators. I mean, I'm a very happy man if organizations just identify their objectives, their risks, and their controls. I'm a very happy man. If they identify the control indicators, that's even better. In the presence of an audit function giving assurance of internal control, I wouldn't believe control indicators should be a priority at this point in time until I get everything else properly established and designed.
Okay, we have a question from J. Parkash Kumar. How the new model different from old?
I explained that already.
Yes, I believe this was answered. Okay, next question. Most of time nowadays, all talks about resilience. How resilience can be handled, managed effectively on project objectives?
Can you repeat that, please?
Most of the times nowadays, all talks about the resilience. Mm-hmm. So the question is, how resilience can be handled, managed effectively on project objectives?
Okay, very nice. So yes, everyone is talking about resilience. Everyone is talking about agility. Everyone, okay, that's good. It's great. We all have the right and good intentions. However, look, resilience cannot be achieved without structure, without processes, without clarity, without governance, without making sure we understand what we want to achieve and the means in which we will be achieving them. Okay, so we all want many things in life. As organizations, we all want to be the best. But doing though and being resilient, being agile requires hard work, requires getting the right people first. So I would like to let's start with culture. We want the right people that can give you the right culture. You need people that do not resist change. You need people that are not toxic. You need people that understand where they want to go. You need people who embrace risk management and embrace all what we have been talking about. Because if you don't have the right people, all of the remaining stuff we are talking about has no meaning. So you need the right people. You need to put them in the proper governance context where it's clear who should do what and who is responsible for what in the organization. Third, we need to make sure that we are designing the right strategy, understanding the right challenges, identifying what is impacting us the most in the organization, and then identifying those risks and controls and the operational risks that may not allow them to be achieved.
Next question from Shalal Al-Otaibi. If you could please talk about ISO 31000.
ISO what?
ISO 31000.
Okay, so ISO 31000 is a risk management framework. We have many risk management frameworks out there. We have the COSO Enterprise Risk Management Framework. We have the COSO Internal Control Integrated Framework. We have Australia, New Zealand, and we have ISO 31000, and we have many others. What I need to tell you about frameworks, all you need to know is that these frameworks provide organizations with the ability to design a formalized, systematic, methodological approach that will enable them to identify objectives, risks, and controls in a methodological manner. Okay? All of these frameworks, in my opinion, communicate the same message, but they do that in different ways. And it's up to you, your professional, let's call it your professional outlook, your professional taste, to decide which one you like the most. As it relates to organizations, my professional opinion, and many people disagree with it, I don't advise you to implement any framework, really. I really advise you to go through all of these frameworks, take from them what really matters to your organization the most, and design and develop your own risk management framework that caters best to your culture, to your organization, and to your existing risk management maturity. So we need to understand maturity is a very important element in risk management. And we need to make sure that whatever we introduce is aligned with that maturity. you cannot go ahead and apply the best practices per se directly to an organization that is still agonizing to understand what risk is. So the ISO 31000 is only a framework that tells you how to go on and do this entire process, like many other frameworks.
Next question, how to effectively activate the role of operational risk by governance and how internal audit can help?
Can you say that again, Ivan, please?
Yes, how to effectively activate the role of operational risk by governance and how internal audit can help?
Okay, sure. So very good question. Internal audit can definitely help by first recommending the establishment of a strong operational risk function. That's one. Two, by providing recommendations on what is needed to establish a strong operational risk management function. That's three. That's two. Three, making sure assessing to what extent are the different departments and functions capable of identifying their own objectives. Four, identifying and recommending to what extent are departments being capable of identifying their own risks. Then same thing applies for controls. Internal audit can help by commenting on the culture of the organization, by commenting on the conduct of the organization, by commenting on to what level of risk maturity we have achieved in the organization. And then it can comment on the output of the ORM. To what extent is the operational risk function in the organization providing us with the right data, with the right information, with the right systems, and so on. So all of that it falls into a major role internal audit can play in that regard.
Okay, we have two questions from people who already left, and since we have a great amount of other questions, I'll skip these two and I'll pass to Victor Teodorico. What is the difference between a lagging indicator and key performance indicator?
Sorry, what's the difference between what?
Lagging indicator and key performance indicator.
Risk indicators.
Would you like me to send it?
Is that what you mean?
Yeah, lagging.
Okay. So if I understand the question,
send it to your WhatsApp, just.
Yeah, I send it to my WhatsApp just so. Okay. So basically, look. Let's not get, let's put things in the right perspectives. We have KPIs, we have KRIs, we have KCIs. At the end of the day, key performance indicators will tell me about to what extent we are able to achieve objectives. Any indicators telling me I am not achieving these objectives or I'm performing poorly could have a corresponding KRI, that is risk indicator, that is materializing. Again, at this point in time, I would really focus. I see so many people jumping certain hurdles, going now directly into KRIs, going directly into KCIs, and not really first ensuring we have identified the right risks. So I would go to first ensuring we've identified the right risks, and then let's venture into the other areas as well.
Okay, so next question we have from Rex Mudenda. What further comment on the notion that risk or operational risk is not absolute in addressing risk, but provides reasonable assurance of things being under control? This is more like a statement, but would you like me to read it again?
Send it to my WhatsApp, please.
Okay. It's sent.
Would further comment
Meanwhile,
on the notion that risk or operational is not absolute in addressing risk, but provides reasonable assurance. First, look, the idea of operational risk is not to provide reasonable assurance. It's to ensure that we are adequately helping the organization identify its objectives, risks, and controls, and making sure that these controls, yes, to a certain extent, are working effectively. But that's, because what scares me when you use the word reasonable assurance, controls are working effectively, that is the role of internal audit at the end of the day. Management has a role to make sure internal controls are are working to a reasonable extent, and internal auditors need to assess the effectiveness of these controls through providing that reasonable assurance. So I would take operational risk, always think about the second line roles as enablers, okay? Enablers of something. They are enabling the management with the ability to identify its objectives, risks, and controls, and so on. Don't think about it as a type of somehow an audit function that needs to give an assessment of some kind. No, think about it as a department that needs to enable something in the organization and make it working appropriately.
Next question is from Ramutu. What risk will the human capital face in the future with the development of AI and machine learning, and how they can overcome the risks?
Okay, interesting question. So definitely AI is going to disrupt businesses. It's going to disrupt processes. And the failure of AI is an operational risk. The possibility of AI is failing is an operational risk on its own. We have to remember that. However, my honest opinion is that look where we were 50 years ago and look where we are today. Disruption, adaptation, new professions, new talent, and new processes and new products and changes. And then we go through that cycle again. Look, I'm a person by nature, I'm a very positive person. I always see things going for the better. Definitely, I see many benefits to AI. Yes, human capital, I agree, will be impacted. However, look, we are in tough times, we are in challenging times. We need to keep on learning and adapting. Unfortunately, those who fail to see the changes coming their way, those who resist these changes, those who do not continuously work on learning and adaptation will not survive the coming disruption, whether we like it or not. This is a personal opinion. Disruption is coming. It's here. If we want denying this fact and challenging it, yes, many people will not have the same type of careers and opportunities that they had previously. Those who understand that university was only the first step of a very long learning path and keep on continuously updating their knowledge and information and seeking new information, they will be able to ride the wave very well. It's a mindset, really. So AI, yes, AI is here. Okay, fine. We need to make sure it works in the best way to our benefits. And from an operational risk standpoint, we need to make sure that they don't fail, because if they fail, we will have operational risks and we will have disruption.
Let's move to the next question. We have quite a few to come to the end. Do you agree on the risk register components must address objective, root cause, event, and impact before inherent score?
Send it to my WhatsApp, Evie. Okay, your question is methodological based. There are many methodologies out there, okay? Each organization decides what suits it best. Look, I will be very honest. I am not a person who likes to complicate things. And risk management, as I said, it is something in the future. There are high levels of uncertainty in risk management. I can make it as technical and complex as I want, and I can make it as simple and less complex as I want. My advice to you, the person who asked this question, and to all of you out there, is you as risk management professionals is not what risk management is for. Risk management has been designed for the risk owners. Okay? The more you complicate it upon yourself to feel that it is a very interesting profession for you, that's great, but you are complicating it more on your audience. My advice to you, based on your risk maturity, let us start and keep it very simple. Objectives, risks, inherent risks, controls. Let's get this right first. Then we can go into residual risk, we can go into KRIs, we can go into KCIs, we can go events and so on. I want to remind everyone one thing, since you are still here. The 2008-2009 financial crisis was the biggest risk management failure for the biggest institutions that were implementing the best risk management practices of that time. Having the best risk management practices and using the best jargon does not make us better risk management professionals. What's important is we design a simple framework and feed that framework with the information that matters. Let's not make risk management just another design profession that aims to have wishful thinking inputted into the program to get wishful thinking results so everyone sleeps better at night until the disaster actually happens. So my answer to you, to answer this question, ask this question, and to everyone else, let's make it simple. Let's get these organizations on board in the simplest forms possible, and from there on, we will take it to more higher and higher levels.
Next question, Mohammed Shukri from Kuwait. Thanks, Mohammed, for the interactive discussion. In Kuwait, we've seen Zain Telecommunication Company announce its first digital banking. Will we've later merged telecoms and banks and change? Okay, this is a long question. So
Send it to me. Send it to me.
will we later merge of telecom of banks and change in the operational risk profile? Okay, yes, let me send it better.
Okay, I'm not a telecom person. I cannot answer that question. I don't know to what extent telecoms will become banks. But for sure, we are seeing the integration of so many services into telecommunication through apps. I'm not really a person who is, I have no idea about telecom, so I cannot answer this question. I'm sorry.
Next question from Raiko Chopic. What kind of impact will have an economy in charge from oil to electric vehicles?
Okay, going from
what kind of? Do you want me to read it again?
Yes, please.
What kind of impact will have the economy in charge from oil to electric vehicles?
Okay, again, I'm not an economist. I'm a very simple GRC man. The impact of going electrical, and I really cannot come. I would leave everyone for their own profession. So I'm sorry, I also cannot answer that question. But definitely, it is if your industry is in the car business, it is an external event that you need to take into consideration how your existing procedures will respond to this, and the failure of these procedures is an operational.
Ali Al-Mansouri, my question is, normally business hide the risk they have, no one is willing to show the risk. What do you do in the situation? Who is responsible and accountable? In terms of risk treatment plan, control, design, creating, who is going? And I think his question continues. Yes, so this is the total of the question shared in few blocks. Would you like me to repeat it again?
Yes, please.
So my question is, normally business hide the risk they have. No one is willing to show the risk. What to do in this situation? Who is responsible and accountable?
If they
And
hide
then
the
it talks
risks?
in terms of risk treatment plan. Yes.
Okay, so look, again, management is the owner of the risk. If they hide the risk and the risk materializes, de facto, they are accountable. However, and I would please, let's make sure we understand. As I said in the second line, risk management has a line to the board. And this line to the board in every industry has been provided with specific roles and responsibilities. In some industries, part of these responsibilities ask the risk management function to communicate to the board any untreated risks. So number one, if you want to talk about accountability, accountability is with management. We agree on this. Now, going a step below, risk management, if it has a line to the board and that role has been defined, based on that role, they will need to communicate that to the board of directors. Ultimately, management is owner of the risk.
Next question. Will risk management best perform as a separate function or part of internal audit department?
Definitely not part of internal audit. Definitely not part of internal audit. Please. I know some people like this. No. Risk management is a second line. Audit is a third line. Each has a different objective. One is part of management, an enabler of risk management, and helping the board of directors design the framework that enables it to identify, manage, and measure risks, and help the management in identifying their objectives and risks. The other one is has an assurance role regarding the effectiveness of internal control. Let us not confuse them. I am against having them under one role.
Peter Lim from South Africa. As you say, digital banking is coming. How do you change the perception of the culture of uneducated men on the street? I believe this could be biggest challenge and the risk of their monies being misappropriated. How do we control this?
Control the change of what, Ivana?
So I believe this could be biggest challenge and the risk of their monies being misappropriated.
The money being misappropriated.
Yes.
Okay. So again, going back to cybersecurity, and as we go digital, we need to make sure we are building the right systems that protect customer data and protect customer information, and raising awareness for customers regarding how to use these apps in a very safe manner. Any failure of these is an operational risk on its own.
What is the main role of risk stewards?
Of risk stewards?
Stewards. I can copy paste your WhatsApp.
Yes, please send it to my WhatsApp, please. Oh, so risk stewards, what you mean risk champions? So risk champions, they are employees within every department. They report to the functional head, but their role in that department is to communicate with the risk management function to make sure that they act as a coordinator and as a communicator of risk management in that department. So they will be trained heavily by the risk management function, and their presence in that specific department is there to help that department be capable of understanding its responsibilities towards risk in a much more effective way.
Ayub Al-Dakail, do you think giving the internal audit the controls that the risk department got from the business is a good idea to ensure that the controls are effective?
This is a tricky question. Send it to my WhatsApp so I read it correctly, please. I don't understand what you mean giving the controls to internal audit. But if what you're saying is that having internal audit assess the effectiveness of these controls, definitely it's a good idea. However, internal audit do not have the resources to audit everything. So we need to make sure we give them the most important controls to test in accordance with their audit plan.
Arza Barisha, do you have any advice how to encourage the first line to understand that they have the risk managing roles in the whole organization? Sometimes, unfortunately, we have the problem that they find us, the LOD2 is always asking for something function, and this causes the less effective risk assessment which the first LOD performs
Send it to my WhatsApp.
annually.
Send it to my WhatsApp.
Okay.
Okay. So my advice to you is the following. I always tell that risk management needs to understand first the level of risk maturity in the organization. If they find this maturity is very low, they need to go on a roadshow. They need to go on a campaign to help them, to help the first line understand their responsibility as it relates to risk management. So we need to make sure that the first line roles have a very good understanding about the need to identify their objectives, their risks, and controls. We go on roadshows, we do presentations, we make sure they have this understanding, and then we go on asking them to develop their own RCSAs and their own risk matrices.
Okay, so this will be the last question for today, and the other questions that are unfortunately over the time that we've dedicated for this webinar will be answered via email. So Abdul Dahan is asking, what should the CRO do in case the BOD are not willing to go through operational risk activities and just to focus on the credit risk side, especially in financing businesses? What is the difference between internal audit and operational risk in terms of assessing actual operational incidents?
Okay, send it to me, please.
So, yes, I'm sending right away.
Okay, so look, that's a very good question. So what do we do if the board does not want operational risk? Okay, what do we do if the board does not want risk at all? Look, it depends on your industry and your regulator. Your role as a risk management function, making sure they understand the dangers of not building a framework. Depending on the industry, if it's a publicly listed company, if it's a privately owned company, there will be different measures that you can take. I cannot answer this question directly. So if it's a publicly listed company, you will have a path. If it's a privately listed, it's a private company, you will have another path. The last question, what is the difference between IA and operation in terms of assessing actual operational incidents? Look, internal audit does not assess incidences. So incidences will be communicated to the operational risk function. The operational risk function will need to do an understanding of why these incidences happened. Was there a loophole in the procedures? And then we can actually enhance and develop and remediate these systems. Internal audit, on a risk-based perspective, they will come at points in time and they will do an assessment as it relates to the effectiveness of internal control. So that is the key difference between them. Internal audit do not keep on reviewing and investigating individual incidences. That is not the case at all. They will assess effectiveness of controls on a risk-based perspective.
That will be all, Mohammed. I'll close this session. I'll take some questions that left unanswered. I can share them through email and will help everyone else who left with no answer to their questions. Thank you so much for your time, dedication, and this great presentation. I do have a lot of thankful message here from the people who are very happy with your presentation. And
thank you.
We will have you at the enterprise risk and the fraud risk session. We'll also have the operational risk course. So for more details that you would like to know about, feel free to email me and I'll connect you to Mohammed Kaisi directly.
Inshallah, inshallah. I want to wish everyone a very nice day. Have a good evening and keep it going.
Thank you. Bye-bye.
Bye-bye.